306% return, just over 2 million. That isn't 200,000, that is just over 2 million pounds in savings from investing £250 a month, and with an initial startup at 10 plan, 3-step investment system or funds that I've chosen and individual stocks that has created and would have got you that return in the last decade. So the decade of 10 years, easy sort of metric to choose from. And if you'd invested 10 grand and left it 10 years ago, that 306%, that 30 grand return is what you would have got. And I can't see this changing. I can't see in any time, if we do the same again in the next 10 years, having much difference, and maybe not quite the gains. There's been a few reasons for that in COVID, and quantitative easing has probably helped with sort of huge growth. But I certainly think double-digit annual returns, 10% plus each year, is really possible. Now, on my channel here, I want to talk to people that really don't quite know what they're doing. And I mean that in the nicest possible way. I think 91% of the UK don't have savings over £100,000, and for a long time I hadn't got a clue what to do, and I don't think the information out there has been terribly clear. There are some fantastic channels and there's fantastic places to get information now. A lot of it, as channels grow, then probably outgrow their audience to a degree where the beginners really need to start. So in this, I am going to show you in this video the three, and it's technically 4 bits, but 3 things I'm going to invest in, the 3-step system where I split the portfolio. We're going to go for a 60-40-10 split. So 60% in something, 40% in another thing, and then 10% in 2 things. And I'm going to show you how in this video. Now, the problem with a lot of people, they keep their savings in a bank account or somewhere that feels relatively low risk. Now, you might get 1 to 4% if you are lucky. Now, inflation has slightly come down recently, but even then, inflation at 2.5-3% means you are not making very much money each day with your savings. And what we want to do this day, I suppose, I digress slightly here, but we're always taught at school, and the school system is not set up for us to win when we get into the big wide world, but we're taught so often to exchange time for money. So go to work, earn money, exchange your time for money, set up a business, do something that exchanges your time for money. And you might leverage it with staff, but that comes with its own issues. We're here with this plan. We could be, imagine what we've just said there, an extra, even, and this is relatively small amounts for what you could be doing, 3 grand a year, a holiday a year, just by putting it into something and not having to do a single thing. And actually, the less you do, the better, i.e. you don't check it every day and you don't go tinkering or doing anything with it every day, will give you a better opportunity of doing well. So we have this problem and we have this culture in this country, and maybe globally, but I can speak for the UK, where we're not taught on where and how to invest. And then it becomes scary, right? And if we don't know, we become fearful. And then when we become fearful, we just get paralyzed. We don't do it, right? So there's lots of stuff we become scared of. And unless we really go out there and face our fears, then we never end up doing it. And I suppose with money, we're so scared of losing it, right? So I might be scared of jumping out of a plane. I could technically lose my life, but no, you can weigh up the risks and go, that's quite safe, and if I'm strapped to somebody, it'd be okay, I can overcome that fear. With money, we don't seem to have that same feeling around it. So in here, this video, I'm going to really knuckle down and help you. If you want, do this. 10 years ago, this would have returned us over 40,000 quid. That is like getting a personal trainer, a dietitian that gives you 6-pack and abs and the best body, hair and a smile without doing a single thing. All by just looking at history and looking at the future and spreading and diversifying that risk. And I'm going to show you how to do that in this video. And again, I'll repeat myself here, I'm pretty certain that this will do something very similar in the next 10 or 20 years. Just at this point of this video, before I delve into the real meat of it, if you're enjoying it and enjoying my channel, please like this video. Please subscribe it. Please subscribe to my channel. Please make a comment below if it's positive, constructive, and hopefully friendly. And if you think I've been of help, there is a free how to get to wealth guide or how to build wealth guide. If you click on the link in the comments below, I'll send you that email. I'll send you an email with that on, and I will be able to help you. I think it's like a little 5 or 6 page guide to get you started in investing. If you pair that with this, we should be on to a bit of a winner. Thank you for listening to that bit. Now, just for context, I wasn't that confident in investing for a long period of time. I thought it was for richer people, and I think there's a huge wealth gap in this country where you get to sort of 100, 200 grams worth of wealth through that, be that high income work or inheritance or whatever that might be, and you're able to go get a financial advisor. And even then I'm a bit cautious about the financial advisor because I think fees are quite high, and we're going to do a video on that. But I would say that you get to that point where it's high level or higher level and you can get a bit more help. Lower level, when you haven't really started, it's a scary world. And I don't think that potentially if you haven't got that huge amount of wealth to start with as well, you might not be able to talk to people in your network or close by that will be able to give you that help and advice. And there's no criticism here, but I was in the same boat and I felt like it was overwhelming. I've started watching YouTube videos. I was interested in it. My dad gave me the book Rich Dad Poor Dad, and that sort of talked about investing in assets and not liabilities. And I got me started in property, and property investing is relatively niche in an investment term and good, and we'll do lots of video and teaching about property investment and how I can help you with that. But I think to have a broader understanding of investing, we need to start, I probably did it the wrong way around, but start with the simple stuff. And what I really love and how we're going to do this is we're going to invest in what we call a stocks and shares ISA. And in my next video, I'm going to literally, this playbook that I'm giving you today, the next video I will go in and show you how to do it. We'll set up a little loom and we'll do that for you. So I think this is the easiest, a simple way to do it. And also on top of that, this is tax-free money. So if you made your £30,000, as we've shown here, that is subject to no tax because we've done it in this stocks and shares ISA. So it is not just a pound earned, it's a pound saved as well. Win-win, always round. So I've been with you, I've understood it. I am not the smartest guy in the room, but if I can help you get 300% returns in 10 years, and again, if we do this sensibly with more savings, with regular sort of savings and regular input to these funds and to what we're going to do here, that 40k could be way, 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 way more. So this is exactly how it works. And we're going to break it down into 3 steps. I'm a bit of a rugby fan, but I also know there's a lot of people that like football, and we're going to build from the back. So our defence is key in both rugby and football, and that's going to be our solid foundation. That is going to be our 60%. So our 60% here is going to be the backbone. This is going to be our global index fund. We will invest in the Vanguard Global Index Fund, code VAFTGAG. I'll put it on screen now. But this spreads our investment and what we put in really wide. So this invests for you via the Vanguard platform, the broker, into 7,000 companies. So you have a little tiny piece of a pie and invest in lots of companies. The reason this is so good is because it doesn't just invest in a particular country. So currently this week and this month, Donald Trump's come in, he's putting tariffs across the world and driving, he wants to drive business in America and take it away from the rest of the world, which is having big shockwaves in the American market and part of the global market. And you're having such a huge risk because you can't vote in, American politics, for example. So investing in the world just lowers our risk. It just means if there's a tremor in one country, other countries either will do okay, or if they're stable, our risk is lowered and minimised. Now, the way that the world is these days is that if there's a shockwave in one part of the world, it does really, the ripple effect does go quite far and wide because we sort of trade with each other in different countries all around the world these days. However, having that spread across 7,000 companies is really, really helpful. And that really lowers our risk. Now, this has done really well over the last 10 years. And this global index fund has returned nearly 16% a year. Now, one thing I'll say now, and I'll say it a couple of times in this part, is past performance does not guarantee future performance, okay? Now, in history, we've averaged around 8% per annum on a sort of global stock market investment return scenario. So we've had 16% growth over the last 10 years, year on year, like averaged. And in this particular fund, now I could be sit here after the last 10 years and saying, well, actually, we've had a 4% loss, because that's what could happen. Now, where we've had the losses, we've also then had sort of big gains afterwards. And very regularly, there could be a big crash, a correction as we call it, and then that will jump back up over time as we sort of work out what the correction was and what the problem was and what the issue was. And the way that the world's set up these days, and there's so many brilliant minds and so many clever people setting up businesses, every time there is a problem or there is a dip in the market because of sort of certain financial crises, because of the dot-com crisis, because of COVID, there's then always been a rebound because people have found solutions, creating new businesses, and then those businesses, especially the big ones, are the ones that you hear of, and really help the world and the stock market grow. So this global index fund is 60% of what we'd invest in this case, the £6,000. It's safe, it's relatively risk-free, and it really spreads and hedges our bets against any shockwaves or any upset. The midfield, they have a little bit of a two-way mindset on this, a little bit defensive, but also could be attacking. This is my spine in rugby league. This is the stuff that's going to be creative, but also not give up too many big plays. So what I want here is the Vanguard Growth ETF. So this, when I was looking at this, it's actually the NASDAQ that I wanted to invest in. The NASDAQ is, and you can invest in the NASDAQ index fund, and the NASDAQ is a US-based market that predominantly focuses on tech funds. Now, the world we live in these days is tech is where a lot of money is going. It's where we have a lot of successful and large companies, and it's only going to go upwards. We've got all the big ones, your Apples, your Microsofts, your Googles that have been around forever, and there will continuously be more tech. America really incentivizes tech companies to go well. There's hubs in San Francisco and LA and even like coming into Austin now, where people are encouraged to go. Venture capitalists are investing in them. Great and brilliant minds are in there, and good companies are getting set up. We don't have the same in the UK. We don't have the same ambition. We don't have the same incentive to set up. And I'd say we have probably some similar minds, but I know a lot of the really great ones are going abroad. So the NASDAQ is a really great index fund market to invest in. And this Vanguard Growth ETF really focuses in on the NASDAQ. And the NASDAQ's great for growth. Now, if tech goes wrong or a couple of those big companies go pop, as they could do, we could see fairly large losses. So, I would say that as a bit of again, past performance doesn't always mean future. But the way that the world's going, the way that tech's going, I really like the NASDAQ. And I see lots of people don't like S&P 500, which is very tech heavy and very American based for lots of reasons. But the NASDAQ is a version of that, or a smaller version of that, and I like it for that reason. So that's why we've invested 30%, £3,000 of this money into that. And now this has seen an annualised, so on average every year, 16.10% growth over the last 10 years. So again, almost double and beaten the market, the average, or the sort of the market that we look at, the 8%, and it's been incredible. Now, the strikers, as it would be, or the real attacking plays, your mercurial players that would be really exciting, and they could give up a big play, but they could also do something really special. These are individual stocks. So I've put 10% into two stocks here, two individual ones that I like. I've seen a lot of good stuff with them. And you could pick either of these two. And also, if you're completely new to this, picking individual stocks is, I would maybe not say a lottery, but unless you are really focused on balance sheets and really looking at finer details of companies, then picking individual stocks isn't the best idea. And that's why you'll see on this 10%, a small proportion is in it. And I find that people that pick individual stocks a lot of the time are because they've heard something. My mate Dave's heard something. I heard Tesla for a long time, Nvidia, like these sort of quite, was it GameStop as well as something like that, where they were hyped up. And Tesla and Nvidia are obviously a little bit more legitimate businesses, but I found that people were investing in them because they'd heard about them as opposed to really research them. So in these two companies, we've got 500 quid, 5% of our spread. The first one's Warhammer. Now Warhammer is a business that I've really liked and has done really well over the last few years. This has grown by 14% annualized over the last 10 years, which is really incredible for one individual stock. It's got a huge fan base. There are so many elements to it, from the arts and crafts, from the little plastic pieces and painting them, to the gameplay, to the community, to I think there's now online gaming with it, and then even films. The community around Warhammer is incredible, and it's been going forever, and then the fan base is so loyal and so diehard that it works really well, and I like it for all of those reasons, and I can't see that going away. Will we see this sort of growth? Maybe not, but I certainly see that Warhammer will continue to progress and play on its fan base that are so unbelievably loyal, and will do really well for that. The other is a little bit sort of more obvious, but this is Google. This is Alphabet. I like Alphabet. I like Google for everything that they do, from obviously the obvious to even investing into the AI stuff. And I can't see, I use Google Drives a lot. I suppose when you're investing in stocks, maybe use stuff, and I don't use Warhammer, but I know people that do, invest in stuff that you would use because you know the product, you know what's good about it, and you know how people would potentially like it. So that sometimes is a good testament to investing into something. Google's returned about 14.5% per annum over the last 10 years. So again, it's had really good growth and has done for a lot of years now. I can't see that changing. They've got so much cash reserve. They've got such an incredible customer base. They have such a huge share of the market that they can be so dominant, a bit like your Microsofts and your Apples. I feel like there's just a bit more to Google than both Microsoft and Apple. There's probably people that know a lot more than me that would sort of argue that point. However, I like Google for that reason, and that is why it's 5% of my little investment portfolio here. So the beauty of all the stuff that we've just spoken about here and the returns is we go to the next point of compounding, which you'll hear me talk about a lot. So every time that we have returns and we get increase in shares and then even some small dividend payouts, which we've got in here, what we do is we reinvest that. And on top of that, every time we have more money in our pot, obviously then our 10%, 15% returns are on the money that is in the pot as well. So the compounding effect of this is enormous. If we carried on and we didn't touch this and the growth and the was the same in the way that we've seen over here, the returns would be huge. The other part of this that I've not done for my 10,000 that I've just mentioned, from the 10 to the 40,000, and I've not put in as an example, is I've not invested any more money regularly into that. I'm not putting extra £100 or £250 or £300 into this like you should. If you saved regularly, as well as having big growth, as well as having compounding, that is, for me, the sort of trifecta, the three sort of attack system there, where before you know it, and I'll do some maths and say I haven't done this accurately, is you will have a huge, huge, huge pot. So this little investment spread has returned about 15% per year for the last 10 years. That's really large. To say that's going to do it for another 10 years is optimistic, but not beyond the realm of possibility. And as we rebalance our portfolio at times and always look at stuff, every 6 months or a year, depending on how involved you are with it, we can maybe keep that. Now, I'm going to share something with you now that to me is really astonishing, and to you should be too. And if this isn't a reason to start investing, I don't know what is. So there's a theory here when I looked at this, did a few numbers, was if you had started with £10,000 and then continually added £250 a month for 20 years, so the 10 years just passed and let's do it for another 10 years. £250 a month is, I think, a really manageable amount for anybody to invest in. You know, minimum wage, that's 10% of minimum wage, and that's something that everyone should sort of look at investing at 10% of their wage. If they can, I understand there's lots of different circumstances, but I really implore anybody that has a wage, try and invest 10% of it as a very minimum. That £250, obviously you'd invested that over 20 years, the £10,000 initial investment startup, and then we'd stayed at 15% with compounding here. Now 50% is large, I will say this, but have a guess what you'd have in 20 years. Have a guess. That's right, just over 2 million. That isn't 200,000, that is just over £2 million in savings from investing £250 a month and with an initial startup at £10,000. That is, well, that's huge. You wouldn't have to do a lot to get to that. And that's my point. So the power of compounding, the power of regular saving, the power of staying consistent is so crucial. Again, I reiterate, past performance does not guarantee future, but even if we had a half of that, could you imagine what that would do for your life? And again, I always say to this, what does that look like for retirement? For holidays, for the kids, for cars, for house savings, for all those bits that you can spend. And this isn't on crypto or the lottery or gambling on anything. So even if you started today, I'm 37 today, even if you started at 40, that 20 years could still be a huge amount of time to get you to 60. A lot of people are in good health there and really enjoy your retirement. And this is just investing a small amount of money into the stock market. Different videos will talk about investing in property and other things that could potentially accelerate that growth in different ways too. Remember, investing isn't about getting rich quick, it's about getting rich slow. It's staying consistent and it's letting other people do the work for you. As I mentioned earlier, if you could subscribe, like my videos, even have a little follow of me on Instagram at @thecyfruin, I'd really appreciate it. If you click on the link below and take the free wealth guide, I look forward to seeing you in the next video. Comment wealth below and I will send you my free how to get started in investing guide.